price to earnings ratio is a fundamental metric used by investors to evaluate the value of a stock. It is a relative measure that is best used when compared with other stocks belonging to the same industrial sector, and it can tell you whether a stock is undervalued or overvalued. In a nutshell, the PE ratio shows what the market is willing to pay for a stock based on the company's earnings. A low PE would indicate that the stock might be undervalued, whereas a high PE might mean that a stock is overvalued. On its surface, the calculation is simple, and it is made by taking the market price of a stock and dividing it by a company's earnings per share. For example, let's assume that a stock has a price of $125 and an EPS for the trailing 12 months of 3.69. The PE ratio would be 33.88. That is, the market is willing to pay $33.88 for every $1 of the company's earnings. By itself, that number isn't very helpful, but when we compare it to other companies in the same sector, we can see whether the stock is over or undervalued. If we say that in this example, the stock belongs to the banking sector with an average PE of 25, this would indicate that the stock is overvalued. Just like when calculating dividend yields, however, the accuracy and usefulness of the PE ratio will depend on how you determine the company's earnings per share. Typically, the EPS is calculated based on a company's reported earnings during the trailing 12-month period. The problem with this, though, is that the data will not tell you anything concrete about future earnings and the true value of the stock for investors. Even if you use predicted future earnings instead, there is of course the risk of under or overestimating the actual earnings. Equally, the market price of a stock may be abnormally high in the short to medium term, perhaps due to investors expecting future growth, and this can also distort the PE figure. This tends to be the case for technology companies, which are heavily demanded, even when the underlying business is yet to turn a profit. Overall, the PE ratio is an easy to calculate and useful metric to use when assessing a stock for investment purposes. But it should always be borne in mind that no single ratio or measure will ever give you a complete picture, and therefore you should use a variety of ratios and information sources to arrive at a clearer picture of a stock's value and its risk profile. Thanks for watching. If you found this video to be helpful, please leave a like and don't forget to hit the subscribe button. And until the next time, stay sharp, stay hungry, and stay cash bright.